right, welcome back to Iron Financial. This is the show where we forge stronger portfolios by putting the market's biggest stories under the microscope. And today we've got a big one. We are running a full-blown structural analysis on the fintech giant Fiserv. You've probably heard the name, you've probably seen the stock. Their latest Q4 2025 earnings are out, and we are here to put this thing under some serious pressure. I mean, we're going to test the load-bearing walls, we're going to check for stress fractures, we're going to find out if this company's financial structure can actually handle the weight of investor money, or if it's about to buckle. Let's get to it. Okay, let's just dive right into the thick of it. The whole reason this report needs a stress test, the reason we're even talking about it, is because it is a masterclass in conflicting signals. It's a puzzle, plain and simple. You look at one page and you see what looks like growth. You turn the page and you see some really alarming weakness. It's just confusing, but that's exactly our job, right? To cut through that noise for you. The real question here is this. Is this a solid, well-built foundation that just has a few cosmetic issues the market is totally overreacting to? Or, and this is the scary part, are these the first tremors that are signaling some deep, critical fractures in the entire business model? You know, this isn't just about one bad quarter. This is about the integrity of the whole structure going forward. And look, here's our blueprint for today's stress test. This is how we're going to break it down. We're running a full 6-point inspection. First, we are going to tackle those conflicting signals head on, no messing around. Second, we're popping the hood. We're looking at that revenue engine to see if it's sputtering. Third, we are going to put the margins under heavy pressure to see if they crack. Fourth, we're going to check the cash flow. Is it a lifeline or is it leaking? Fifth, we're going to analyze management's own blueprint for the future, see what they're promising. And then finally, we're going to deliver the iron verdict, the big one. Is this a structure you build on or is this one you bail on? Let's get started. All right, section 1 it is. This is where all the confusion really starts. Because on the surface, you know, if you kind of squint and look at it just right, some of the full year numbers look stable, maybe even a little encouraging. But the market, well, the market is not buying it. Not at all. The stock has been absolutely punished, dropping over 54% in just the past 6 months. Now, that is not a minor correction. That is a massive vote of no confidence from investors. The market is always looking forward, and right now, it's pricing in the risk that the cracks we're about to show you are just the tip of the iceberg. The big money is sensing that something is fundamentally wrong under the hood, so let's pop it open and take a good look at that engine block. And here we go. This is the house divided, right here on one slide. As you can see on the left, the bull case is pretty simple. They'll point to those full year numbers and they'll say, look, full year GAAP revenue grew a respectable 4%. Not bad. And hey, full year GAAP EPS is up a very strong 18%. The structure is sound. Move along. But is it really real strength or is it just a mirage? I mean, I'm looking at the right side of the slide and that's what's telling the real story. The most recent, the most relevant period, the fourth quarter, organic revenue growth just slammed to a halt. Flat. Zero. And worse, look at the adjusted EPS, the number that's supposed to show the core profitability of the business. It just fell off a cliff, down a shocking 21%. And you want to know about that 18% full-year GAAP EPS growth? It's completely misleading. It's only there because the year it's being compared to, 2024, had a huge one-time write-down. It's an accounting trick. It's not real operational growth. You take that little anomaly out of the equation, and the whole picture looks a heck of a lot uglier. The momentum isn't just slowing down, it's reversing, and it's reversing fast. That jarring reversal leads us directly to the next critical component, the revenue engine. See, a truly strong company, one that's built to last for decades, needs all of its engines firing in perfect sync. It can't rely on just one part of the business to do all the heavy lifting, while another part is leaking oil and sputtering out. So the question is simple. Are Fiserv's engines firing on all cylinders, or are we starting to see some serious cracks in the core business? Let's run the diagnostics and find out. Okay, so management will hold up this number, 4% organic revenue growth for the full year. And look, it's not spectacular, it's not going to set the world on fire, but it looks like steady forward progress. It suggests the core business is still expanding, still building, still moving in the right direction. But what they really don't want you to focus on is this number, 0%. In the fourth quarter, that 4% annual growth rate hit a brick wall. This isn't a slowdown, people. This is a full stop. It just begs the question, what in the world happened? Where did all the growth go? A healthy business doesn't just decelerate from a solid growth path to 0 overnight. Something broke. This points to a fundamental problem that showed up late in the year, and that, my friends, is a massive red flag. And this chart just brilliantly illustrates the problem. When we actually break down that full year 4% growth, we see it's not a balanced effort at all. The merchant solutions segment, that's the part that powers payments for businesses and retailers, It's doing all the heavy lifting here, growing at a respectable 6%. But then you look at the financial solutions segment, their core business serving banks and credit unions, it grew at a sluggish 2% for the whole year. That is not just lagging. In this inflationary environment, growing at 2% is basically going backwards. This is not a company firing on all cylinders. This is a company being dragged forward by one half of its business, while the other half is faltering, and faltering badly. And look, don't just take our word for it. This isn't our opinion. This comes straight from the CEO's mouth. When he was pressed on this very weakness in the conference call, Mike Lyons admitted, and I quote, "We have lost some market share, especially on the smaller credit union side of our business." So the crucial point here is that 2% growth number isn't just about a tough macro environment. No, it's a direct admission that they are losing ground to more agile, more aggressive competitors. You've got companies like Jack Henry & Associates and Q2 Holdings that are specifically targeting these smaller institutions, and they're offering better tech and more flexible platforms. Fiserv is actively being beaten in the marketplace. That is not a small crack. That's evidence of foundational erosion. And when you're losing the fight for customers, it is only a matter of time before that pain shows up big time in your profits. Which brings us to our next test, the margins. Okay, let's move on to section 3. Losing market share has a direct impact on profitability, and that's exactly what we're going to examine now. You know, revenue is one thing, but profitability is what truly determines a company's structural integrity. A building can look incredibly impressive from the outside, but if its internal steel supports are corroding from pressure, well, it's a disaster just waiting to happen. For Fiserv, the profitability numbers are where the biggest, most alarming stress fractures start to appear. And here it is. This right here is Exhibit A for the bear case. Just look at this table. In the fourth quarter, GAAP EPS dropped 8%. Not great, but the real story, the one management actually wants you to focus on, is the adjusted EPS. And it didn't just drop, it collapsed, down 21%. A 21% drop in a single quarter is not a dip, it's a free fall. This signals a catastrophic failure in profitability. It means that for every single dollar revenue that came in the door, far, far less of it made it to the bottom line. This points to one of three things. Either their costs are out of control, they're facing severe pricing pressure from competitors, or they're having major operational failures. Whatever the cause, the end result is exactly the same. The structure is weakening. And again, don't just take it from us. This isn't just our interpretation of the numbers. This is from a third-party analysis by Stock Titan, and it validates the concern completely. They note the adjusted earnings and margins under pressure, pointing to weaker underlying profitability. It's pretty clear. When independent analysts are highlighting the exact same severe weakness, it just confirms what the raw numbers are already screaming. This company's ability to turn $1 of revenue into $1 of profit is deteriorating at a really alarming rate. This slide really puts the corporate jargon in direct contrast with the cold, hard data. It's pretty stark. On the left, you have the CEO, Mike Lyons, talking about taking decisive steps and executing the One Fiserv plan. It sounds proactive, it sounds confident, but is it just hype or is it real? Look at the numbers on the right. GAAP operating margin in Q4 plummeted from nearly 32% all the way down to 24%. And their preferred metric, the adjusted operating margin, it cratered from almost 43% down to under 35%. You just have to ask the question, what decisive steps result in an 800 basis point collapse in adjusted operating margin in a single year? That isn't a squeeze, that's a margin compression of epic proportions. The plan, whatever it is clearly absolutely not translating into profits. So let's just recap for a second where we are. Revenue has stalled out and margins are collapsing. I mean, at this point, you'd think the whole structure is condemned, right? But hold on. There's one pillar that the bulls always point to as the ultimate support beam: cash flow. They argue that while earnings can be messy, they can be manipulated with accounting, a company's ability to generate cold, hard cash is its ultimate survival tool. So let's test that theory. Is the cash flow the financial bedrock that can save this company, or is it also showing some serious signs of decay? Okay, let's be fair. This is a massive number. For the full year, Fiserv generated $4.44 billion in free cash flow. This is what you'd call the company's solid financial bedrock. It's an enormous amount of cash that provides immense strength, a ton of flexibility, and the ability to weather pretty much any storm. It allows them to invest in the business, pay down debt, and return capital to shareholders. On its own, this number is undeniably impressive. But a number is pretty meaningless without the trend and the context around it. Yes, $4.44 billion is a lot of cash. But as you can see on the right, last year it was $5.23 billion. That's a decline of nearly $800 million, or about 15% year over year. So while the foundation is still there, the ground beneath it is starting to erode. The company's core cash-generating power is weakening, and that undermines the entire bull case for cash flow. You have to ask why. Why is a company with supposedly growing revenue generating significantly less cash? That's a serious structural question that needs an answer. And this is where the capital allocation strategy really comes under intense scrutiny. In 2025, Fiserv spent a staggering $5.6 billion on share buybacks. Now, management will frame this as a sign of incredible confidence in the company's future. But let's connect the dots here, because this is important. The company generated $4.44 billion in free cash flow, yet it spent $5.6 billion on buybacks. Think about that. They spent over $1 billion more buying back their own stock than the business actually generated in cash. Is that a prudent use of capital when your revenue is flatlining and your margins are collapsing? Or is this just financial engineering, designed to prop up the EPS number by reducing the share count while the underlying business really struggles? To me, it looks a lot less like a sign of confidence and more like a desperate attempt to manage perceptions. Okay, this brings us to the final and perhaps the most crucial piece of our entire analysis: management's own guidance for the year ahead. This is the blueprint they've laid out for investors. It's their promise for future construction. After a year of decisive steps and what they called a necessary reset, this is what they expect to build in 2026. So, the question is it a blueprint for a skyscraper, or is it a blueprint for a garden shed? All right, let's break this down. For 2026, they are guiding for organic revenue growth of just 1% to 3%. Let that sink in. The high end of that range, 3%, is still lower than the 4% they just delivered in what they themselves called a tough 2025. This isn't a recovery story. This is a story of managed decline. They are explicitly telling the market to expect, at best, really anemic growth for the foreseeable future. There's just no way to spin this as a positive. But forget revenue for just a second. The real story, the number that tells you everything you need to know about management's confidence in their own plan, is profit. For the full year 2025, the company delivered adjusted EPS of $8.64. Their guidance for 2026 is a range of $8 and $8.30. The midpoint of that range is $8.15. That means, after a full year of executing this one Fiserv transformation plan, their best guess is that adjusted earnings per share will decrease by nearly 6%. This isn't a blueprint for growth. It's a blueprint for stagnation at best and managed decline at worst. This is management telling us, in their own words, that the margin pressure and the operational issues are not going away anytime soon. All right, we've put it all through the ringer. We've pressure tested every single pillar of Fiserv's financial structure. We've looked at the revenue engine, we've examined the profit supports, we've checked the cash flow bedrock, and we've analyzed the blueprint for the future. Now it's time to put it all together and deliver the iron verdict. So let's assemble the final pieces. Step 1, you have to acknowledge the bedrock. The company does generate an immense $4.44 billion in free cash flow. That is a powerful positive that provides a foundation and a flexibility that many companies would kill for. But then we move to step 2, the cracks. And wow, are they deep. We're talking about severe margin compression, revenue growth that literally flatlined to zero in the fourth quarter, and a direct admission from the CEO of losing market share in their core financial segment. These are not cosmetic issues. These are significant structural weaknesses. And that leads us right to step 3, the blueprint. The plan for 2026 projects another year of minimal growth and, shockingly, shrinking profits. It offers very little confidence that a turnaround is just around the corner. And that brings us to our unified verdict. Fiserv is not a total collapse. That cash flow foundation is strong enough to prevent that, at least for now. But the structure is showing serious, undeniable operational cracks. The combination of declining margins, sputtering revenue, losing market share, and a really weak blueprint for 2026 makes this a very high-risk proposition. This is not a turnkey, move-in-ready investment. This is a fixer-upper that requires major repairs. And there is absolutely no guarantee that management's current plan is up to the task. The risks are just too high, and the path forward is very uncertain. So we're going to leave you with this final question to consider for your own analysis. Is Fiserv's massive cash flow a solid enough foundation to build upon for your portfolio? Or are the deep operational cracks a sign of a structure that's on the verge of a teardown? As always, you have to do your own due diligence. That is the only way to forge a truly stronger portfolio. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.